Netflix's sweeping measures to curb password sharing are showing promising results in turning freeloaders into paying customers in the United States, according to early data from Antenna. Joining us now is Rich Greenfield, Lightshed Partners. That's a little harsh, isn't it, Rich? I mean, I guess they're freeloaders. But this has been a while. It's been difficult to try to figure out for the company. This is going to do it?
Well, you sort of remember back in the days, I remember Richard Plepler teasing Netflix about sharing passwords, HBO, Richard Plepler back in the day. And for a long time, Netflix was okay with sharing passwords because you had such incredible organic growth. But when you sort of get up well north of 200 million subscribers and you still have, sort of 100 million people that are accessing accounts that don't live in the same household as the person who has the account, that you sort of need to crack down. I mean, look, Netflix did two things last year, made two big changes because they had to find growth. One, they launched advertising, right? Like that was something they had pure religion against, and they gave that up because they had to find growth. That seems to be working out quite well. And they announced that they were going to start cracking down on passwords. We've seen that start to roll out, over the course of the last 6 months. Obviously, the big push was in the U.S. just a few weeks ago. I think, Joe, the one really important thing to keep in mind is Netflix has learned a lot. The early password sharing crackdown, places like Canada, Spain, Latin America, you saw a lot of noise because of the way they were doing it. They made some real fundamental changes to how the rollout works. And those changes have led to a far more muted response. And I think that's why the stock is rallying so hard over the course of the last 4 or 5 weeks, is increased confidence that the password sharing rollout not only is happening, but is actually working far better and faster than it did in other markets.
Oh, 160, Rich. Right there in the last year. And I knew it, but couldn't do anything about it. But 160 to 421. I guess we should have known at that point. Did you mortgage your house and buy Netflix at that point?
No, but I think we've said on CNBC multiple times, we continued to believe that this was the winner. And I think, look, there's another part of this story that we're not talking about, Joe, that you know well, which is there was this extreme push by all of the peer group, whether it's your parent company with Peacock, whether it was Disney and Disney Plus, Hulu, et cetera, Paramount Plus. Everybody jumped into the streaming wars and everybody was willing to lose billions of dollars chasing subscribers with no real focus on profits. Now that all of Netflix's peer group is really focusing on profits, it's really allowing Netflix to further differentiate. They just have far more content. They have a bigger marketing push. Everyone else getting out, or not getting out, but certainly scaling back their endeavors. Like Warner Brothers Discovery, David Zaslav does not want to be Netflix. He has a focus on profits, improving the balance sheet. He is not trying to kill Netflix the way the prior team was. I think that tremendous change is actually a nice tailwind that Netflix is back. And I think you're going to see more. Like, I don't think Peacock can keep losing $3 billion a year. I don't think Paramount Plus can keep losing $2 billion a year. You're going to see all of these companies focus more on profits. And as they do, I actually think that's a nice tailwind on top of password sharing and advertising for Netflix.
Things move, life moves pretty fast. You got to, better not blink or you could miss it. I was watching, you mentioned Zaslav. I'm thinking about Logan Roy, who said, we're bleeding out from losing advertising, cord cutting's continuing. We got to get into streaming. We got to do that. I'm like yelling at the TV set, no, that was only last year when he
remember,
decided.
Joe. Well, remember advertising. So Netflix a year ago did advertising because it was seen as like they got it, like Reed Hastings was like, we got to do something to get growth back above 10%. And so it was very defensive when they first launched advertising. What you're seeing now, and I think, we wrote a whole piece on this a couple of weeks ago, and I think what's really interesting, Netflix is moving from defense to offense when they think about advertising, because now they're actually going in. This is the heart of the upfront. And they're going in and they're saying, we want your ad dollars too. And so the cord cutting that you just mentioned was the beginning problem, right? Like you're losing subscribers. Now you're going to start losing your ad dollars to Netflix. And it's very early. It's a small business, but it's growing very rapidly. And, co-CEO Greg Peters has really spearheaded their push into advertising. I would keep an eye on how offensive the advertising is, as they offer advertisers a more compelling way to reach consumers in 2023 and beyond than what they can do on linear TV. And that's sort of the double whammy for linear TV that's going to make life that much more difficult, and I think really help Netflix stock over the course of the next 12 to 18 months as they go on the offense versus being on their heels and playing defense.